The results of the Greek elections have bought the eurozone some breathing space, but there remains a heightened sense of risk perception across Europe and continued shortages in terms of trade finance liquidity from the banking sector. Sovereign risk and this shortfall in funding for trade were the central themes at Exporters Trade and Supply Chain Finance Conference in Amsterdam.
So as banks will face scarcity of funds and increased capital requirements in their business, they will have to take measures. For some banks it will mean to shrink actually in size. Other banks, by rationalizing processes, cost cutting, can raise capital internally sufficiently to be able to sustain activities. Well, ING is one of the banks that is able to maintain balance sheets. That means also commitments in lending. Whereas other banks who have to shrink will reduce their funding and thus lending to customers.
Risk is also a concern for corporates, with fear around not being paid for goods ever increasing. Protecting global supply chains has become a key priority for companies active in international trade.
A lot of clients' primary concern is they want to protect the physical supply chain, and all of those things, whether it's economic, whether it's political, whether it's natural disasters, all of those have the potential to affect the physical supply chain. If I think about the last 18, 24 months, client behaviour has definitely changed. One of the primary drivers around that is risk management.
As a result of this new mindset, banks are reporting rising interest in their supply chain finance programs.
Where there are suppliers in that supply chain who may not have as good a credit rating as perhaps some of their buyers, they might have had difficulty in obtaining finance if they continued trading on an open account basis. What you'll find now since the crisis, the banks and partners are being approached more, which means that the banks are able to finance those suppliers and then continue that trade.
Funding from banks becomes scarce, and that buyers and suppliers are looking for alternatives. And one of these alternatives could be supply chain finance.
So there are many opportunities for banks to finance these supply chains, but the problem in fulfilling this potential really comes down to funding capacity. Banks will have to start working together.
We've had situations where we've bid for some business with another bank, and then the corporate will come back and say, well, actually, we're going to order to 2 or 3 banks because we want to diversify our risk. Now, go back a few years, that was pretty much unheard of. And you'd actually be quite upset as a bank about that. But now you're actually quite pleased about it.
Unfortunately, a number of European banks continue to lack this funding capacity.
I think there is sufficient liquidity, but only with certain banks. So there are certain banks, particularly in Southern Europe, who are having issues with liquidity. And this is what the theme of this conference has been about in terms of partnering. So we're working very closely with some of our FI clients in Southern Europe who may be able to cover risk but won't be able to cover the liquidity. So it'll be up to more global banks like ourselves to assist in the liquidity of transactions.
Many companies are now turning to insurance for support, and insurers are being asked to cover risks across Europe and not just in the emerging markets.
Certainly with the eurozone crisis with reduced liquidity, either banks or industrial companies are looking for insurance to support transactions. So that could be industrials, it could be traders, and it's part now of their business process rather than as a last thought.
So despite some relief following the Greek election, it looks like bank funding for trade will continue to be constrained for some time. And although interest in supply chain finance has grown, its success will come down to whether the market can raise enough liquidity to support it.